Okay, so the first one is current ratio and asset test ratio, or you can say that it is as quick ratio. So current ratio, okay, the formula is current asset over current liability. Okay, so this ratio indicate the extent of firm's liquidity is measured by the firm liquid asset over its liability. Okay, asset test ratio, okay, just same with the current ratio, but you have to minus inventory. Okay, so asset test ratio, current asset minus inventory over current liability. So asset test ratio actually measure the ratio of current asset less the stock to current liability. Okay, let's say current ratio, okay, equal to, okay, current asset, this one amount 1182,000 over 944,000, so equal to 1.25 times. Whereas asset test ratio, this one current asset minus the inventory first over current liability, you will get 0.791 times. Okay, so this one means for every 1 ringgit of asset, okay, in the firm, so the firm has 1.25 times ability to pay. Right, and then asset test ratio, okay, for every 1 ringgit of asset after deduct the inventory, so firm has the ability to pay 0.791 times. Okay, next, inventory turnover ratio. What is inventory turnover ratio? Okay, inventory turnover ratio is how much cost of goods sold, okay, over the stocks that the firm have. So the formula is cost of goods sold over stock. So inventory turnover ratio equal to 2 million. Okay, this one in the income statement, you just take the COGS over the stock or inventory. Okay, is same, stock, inventory and goods. Okay, so you get 5.7 times. So the firm has ability to replace 5.7 times for every one of the stock that have been used. Okay, inventory turnover ratio. And then inventory turnover days, stock over cost of goods sold, is equal to 365 days. Okay, inventory turnover days, okay, this one in the income statement, you have to times 365 because 1 year is 365 days. So you will get 63.97 days. Okay, it indicates the relative liquidity of stock in the firm. Okay, whether the firm has ability to replace the inventory. Okay, so inventory turnover days means the firm has ability to replace the inventory within the 63.97 days. Okay, what is account receivable turnover ratio? Okay, it indicates how long it takes for firm to collect its receivable. You know that receivable is when our customer, okay, buy your goods or items in credit sale. So if you count the account receivable turnover ratio, you may know that how long it takes for firm to collect all the receivable. So the formula is credit sale over credit debtor. So in the income statement, you take the figure divided by credit debtor, you will get 7.7 times. So basically, the firm have 7.7 times day, or you can take it into 8 days. Okay, account receivable turnover ratio, the firm has 8 days, average of 8 days in order to collect it receivable. And then account receivable turnover days, you the formula is this one, credit debtor over credit sales times 365 days. Okay, the formula you plug in, then you get 47.44 days. Okay, sorry, just now is the firm has ability for 7.7 times in order to collect the all the receivable, And this one, you can 47, this one, okay, you just take 47 days in order to collect all the receivable. Okay, what is account payable turnover ratio? Okay, just now account receivable. Okay, this one account payable turnover ratio. So it indicates the extent of how quick the cash outflow are in firm. Okay, the formula of account payable ratio. Okay, credit purchase, or you may plug in account payable figure over trade creditor. Credit purchase over trade creditor. Okay, you will get 7.3 times. Then account payable turnover days, account payable over credit purchase. Usually in the question, they also can give the credit purchase times 365 days. So you will get 50.44 days. Mean that's firm has 50.44 days in order to collect the in order to pay the account payable, or in order to pay their credit terms. Okay, for leverage ratio, what is leverage ratio? It investigates how firm being financed and provide indicator as to extent a firm is able to meet the interest payment. Okay, when the firm already borrow from the bank, so how much days firm taken, okay, how many days the firm taken in order to meet the interest payment. Okay, this is the formula. Okay, debt ratio equal to total liability over total asset. Okay, total liability over total asset. This is first formula. So it indicates that more than 83% of firm total asset is financed using debt. Okay, debt ratio more than 83, or this one you can decimal point, right? So it is 84% of firm total asset is financed using debt. Whereas, okay, debt ratio also you can use this formula, total long-term borrowing over total equity. Okay, you will get 4.36 or 436%. Okay, so for interest cover ratio, the formula earning before interest and tax, or we can say it as EBIT. Okay, EBIT over interest expenses. So you will get 3.63 times. So basically, it means that firm has earning before interest and tax that currently cover up to 3.63 times its existing interest expenses. So firm may still be able to take on further borrowing because there is excess of 3.63 times on its existing interest expenses. Okay, efficiency ratio. It means that the extent to which a firm able to earn sufficient earning and return to its investor. Okay, investor has been invest, so it you want to determine whether the firm has ability to pay back to the investor. So you can efficiency ratio can be divided by EPS, earning per share, okay, return on capital employed, return on asset, and also return on equity. Okay, this is the formula of earning per share. Earning attributable to ordinary shareholder divided by number of ordinary share times 100 cents. So earning per share you will get 34 cents. So meaning to say that for every one ordinary share held by shareholder, ABC has earned 34 cents of income, which may be either received to ordinary shareholder as dividend or kept in the firm as retained earning, but still belong to the ordinary shareholder. Okay, because you have to pay dividend to the shareholder. Okay, for every one ordinary share, okay, earned by the shareholder, you have 34 cents dividend that you can pay to the shareholder. Okay, return on capital employed, or ROCE. So the formula, this one, earning before interest and tax over capital employed times 100. So capital employed basically equal to long-term debt plus equity. So return on capital employed, you will get 6.32%. So assessment of the level of efficiency of management of ABC Sdn Bhd. Okay, you can evaluate that. For every RM of funding provided by the management of ABC, the firm is able to earn a return of 0.063 annually on average. Okay. Okay, whereas for return on asset, okay, this is formula: profit after tax over total asset times 100. So total asset is actually non-current asset plus current asset. Okay, I show you earlier through the income statement. So you will get 3.15%. So for every RM of asset that is made available to the firm, the management able to generate return after tax is 0.0315. Okay, for every RM of asset, so firm can generate return of this one. Okay, return on equity. Okay, return on equity equal to profit after tax times profit after tax over total shareholder equity times 100. Whereas return on ordinary equity, this one the formula, but you have to deduct preference share. Okay, so based on the example, after you calculate, you will get return on equity of this figure and return on ordinary equity of 19.63%. Okay, market ratio consists of three. Market ratio are ratios that are based on the market price of a share. So market ratio consists of price earning ratio and market to book ratio. Okay, price earning ratio. So the formula here, price per share over earning per share. So you will get 10.29. So meaning to say that ABC Berhad share currently sell for 10.29 times its earning. Okay, the amount of share you can sell for 2.29 times its earning. So firm with high price earning ratio are generally taken as firm with bright future prospect. Because of what? Because they can sell higher than its earning. Okay. Okay, market to book ratio. What is market to book ratio? So you have to calculate price per share over book value per share. Okay, so you will get 1.74. Then market to book ratio, you will get 2.01. So basically, market to book ratio compare the market price of firm share relative to its historical cost of the share. Means the share that you sell to the shareholder. So it's the historical cost, means the cost of share that you sell at the first place. Okay. Okay, this is also another analysis that you can use, okay, which is 2-point analysis. So this one you can just take note lah, the formula. Okay, time series analysis, you can compare between firm current year ratio with the same ratio of the previous year. So you have this analysis is in order to ascertain that the firm situation has improved, worsened, or just the same. Okay, no change between 1 year and the subsequent year. Okay, last but not least, 2-point analysis, and then cross-sectional analysis, and also the limitation of ratio. You can read through the slide I have given to you. Okay, till we meet again. Thank you. Bye.